Hi friends, Mohit this side. Welcome to our video on the 2008 stock market crash. This event was one of the most significant financial crises in recent history and had a major impact on the global economy. In this video, we will take a closer look at the causes of the crash, the impact it had on the economy and the steps that were taken to mitigate the damage. We will also discuss the ongoing efforts to prevent future financial crises. So, join us as we delve into the 2008 stock market crash and explore the events that led to one of the most dramatic declines in stock market history. Market crash was the subprime mortgage crisis. Banks and lending institutions had been giving out risky mortgages to borrowers with poor credit, often with little to no documentation of their income or assets. These subprime mortgages were then packaged and sold as securities to investors all over the world, including pension funds and other institutional investors. As housing prices began to decline, many homeowners found themselves unable to make their mortgage payments, leading to a wave of foreclosures. This caused a domino effect that led to the failure of many large financial institutions and a severe decline in the stock market. Other contributing factors included a lack of regulation, a housing bubble, high levels of debt, and the failure of large financial institutions. Impact on global economy. The 2008 stock market crash had a significant impact on the global economy. The most immediate impact was the loss of jobs and homes as a result of the foreclosure crisis. This led to a reduction in consumer spending, which further contracted the economy. The crash also led to a global financial crisis, as many major financial institutions failed and investors lost confidence in the financial system. This led to a credit crunch, where banks and other lenders were unwilling to lend money, making it difficult for businesses to borrow and invest. This, in turn, led to a decrease in economic activity and an increase in unemployment. Some of the most affected countries were United States, Europe, and developing countries who heavily dependent on exports to developed countries. The crisis also led to a wave of government interventions, bailouts, and monetary policy changes to stabilize the economy and prevent a complete collapse of the financial system. Here is the conclusion of 2008 stock market crash. In conclusion, the 2008 stock market crash was a significant event in recent history that had a major impact on the global economy. The crash was caused by the subprime mortgage crisis, which led to a domino effect of failures in the financial system. The crash resulted in a severe decline in stock prices, a loss of jobs and homes, a reduction in consumer spending, and a global financial crisis. The government and central banks intervened to stabilize the economy and prevent a complete collapse of the financial system. However, it took many years for the economy to fully recover, and it had a long-term effect on the global economy and the people affected by the crash. The event also highlighted the need for better regulation, risk management, and oversight in the financial industry to prevent future financial crises.